Okay, a question from Shalonda. Actually, not a question. Shalonda is saying, very comprehensive, still processing.
I speak very quickly and I put a lot of content out there.
Welcome everyone to the TTA webinar series, Mastering Business Essentials. We've got part two today of this six-part webinar series with Marc Crawford of Swan Insurance. Before that, I just want to mention that this series is sponsored by Bambi, which is the most stupidly easy to use and powerful NEMT software for dispatch scheduling and routing. And if you're not already a member of the TTA, here's 4 super quick, awesome reasons to join. Number 1, educational resources. So you get access to webinars like the one with Marc Crawford today, seminars, training sessions, newsletters, reports, publications, all that good stuff. Number 2, advocacy and representation. TTA's already built channels with the government to advocate about things that matter to the industry. You get to directly participate in that and have your concerns heard. Number 3, networking events with industry leaders and experts and your fellow TTA members, including this year's TTA Mobilize conference at Paris, Las Vegas. Boom. And number 4, everything I just mentioned, you get great member discounts on all that stuff. So without further ado, Marc Crawford of Swan Insurance is going to talk to us today about strategic growth and risk control for NEMT fleets and insurance. Marc, over to you.
Thank you, Nirav. Pleasure to be here. Great to see everybody. Appreciate you spending the time today to join us on this webinar. Great 6-part series. We look forward to being the second of 6. And just a reminder that these are recorded. So again, if this is during the business day and you don't have time to allocate an hour, feel free to pull up the link and watch this at your convenience. I think there's some good value. I hope to impart actionable items from a strategic risk and control perspective today. I recommend really that this presentation is going to be about fleet operators. So just to make it very easy to understand, we define fleet as 10 vehicles and 3+ years of operation in NEMT. This is focus on growth operators. So again, we're looking at what you can do in the next 12 to 24 months. I strongly recommend, if you are a non-fleet, to stay on the presentation. If you're a new venture, we can go back. Bambi has a library of videos, which has great content. Nirav and I known each other for several years. We did a video for new ventures. It's Insurance 101 for new ventures. It's a 30-minute presentation, gives you everything you need to know from a new venture perspective. But for this presentation, again, I just want to be clear that we are looking at a growth fleet strategy for the next 12 to 24 months and how you can implement that for your operation. So I'm going to begin. Again, this is strategic growth and risk control for NEMT fleets in insurance. During the next 45 minutes, again, I'm going to cover a lot of topics. Each of these topics could probably take, a couple hours to define in detail. I just want to give you an overview, again, with the goal of having questions, answering those questions, and working to sit down and have a deeper discussion on this. Again, as I say, we are a transportation brokerage. You don't have to work with us. There are other good transportation brokerages out there. Just make sure that they are transportation wheels-based brokerage, that they know what they're doing. Because I will say, from me and my team, we fix a lot of issues from people that don't really know what they're doing in this industry when it comes to risk management and insurance. So I just implore you, please make sure that you work with the transportation brokerage, again, in the transportation realm. Again, I'm going to go through a very high overview of myself and Swan Insurance. Again, Swan stands for Sleep Well at Night. Our operators sleep well at night because we cover their risk management. And there's a lot of exposure when you're moving seniors. I like to say, when you're moving my grandma from her house to the hospital, that's my most precious asset. So it is very important for me to have awareness and trust in your operation. And I want you to understand that we work for you and partner with you to protect your exposure as a transportation operator. I'm going to define fleet operations. Again, we'll go through 4 bullet points on this and just really understand what we consider a fleet and how you're going to grow that fleet. An implementation of a fleet plan. Again, we need a plan of action, and we'll go through the structure that we provide our fleet ops. And again, that's based on ride volume, taking that a step back to number of units to be able to hit that ride volume. And 3, the financial piece. Ken did a good job last week of talking about that from the financial metrics. I mean, if the end result is to sell out on the NEMT, how do you want to grow this to sell? Utilization of telematics and cameras. From a risk perspective, we are going this way. So we need to be aware of what's going on in the industry. Utilizing not just front-facing cameras, 360 cameras. And this is to protect you as the owners. This isn't for obtaining a slightly better rate in insurance. At the end of the day, it's safety within the operation. Everything trickles down from the drivers. The driver behavior. If you can manage driver behavior, incentivize those drivers for good behavior, and build a culture of safe driving through that driving behavior, then a lot of the insurance issues tend to go away. So again, we'll talk about telematics and cameras utilization today and what I expect to see over the next several years. And then claims. Again, at the end of the day, claims will make or break your operation. On a long enough timeline, we all have claims. The question when it comes to claims is who handles those claims? What is the speed of issuance and closure? How aggressive is your partner? And it should be your risk management partner, in our case, the brokerage that works on your behalf to close that claim with the insurance carrier. Just a reminder, the word broker means an insurance broker is working on your behalf. An agent, an insurance agent, means they are working on the behalf of the insurance company. So something to just be weary of when you look about the difference between insurance broker and insurance agent. Who does that individual work for? I work first and foremost for my TPs. My transportation clients are my clients. We do have to work, of course, with the insurance carriers, but I will work on your behalf to negotiate, to fully understand, to present your operation in the best light. All right, Swan Insurance, again, as I said, we stand for Sleep Well at Night. We are a wheels-based brokerage, meaning that we are 100% transportation. We move 1 cargo, 2 people. I am a principal and I'm director of NEMT programs. NEMT programs include non-emergency medical transportation, EMS, and ambulance. So upstream, all health-related transportation of people. Again, we talk a lot about insurance. At the end of the day, you need a broker, an insurance broker that understands transportation. We are in 38 states. Currently, we have 423 fleet operations in the NEMT space. We have multi-fleet operations. Again, this isn't to pat myself on the back or us at Swan. It's more to say that we have seen issues. We have seen what works. We have seen what doesn't work. We clean up a lot of placements that are, for no better term, opening the TP up to huge exposure. And it's a scary situation when I look at someone who has been misplaced on insurance and they've been driving with an exposure, and knock on wood, they haven't had a claim, but if they would, they'd be completely open to litigation. So again, it's knowing transportation, it's knowing ride broker contracts, it's knowing managed care organizations, it's knowing hospital contracts, assisted senior memory care contracts. It's understanding what you really need from a state level, from a county level, and backing that out. So again, I'm not just a broker I work in the industry. I sit on several boards for health directives here in Kaiser as well in California. I'm certified to train the trainer in stretchers. I'm wheelchair certified. I have work and I consult for TPs in both NEMT and EMS. So again, I am fully versed. I like to think I'm fully versed, more so than just an insurance agent or an insurance broker, in working with you to understand the risk and, or I should say, with the objective of you growing your fleet operation. So let's jump in now. Let's define a fleet. And we talked about this on the first slide. This really is a focus of 10 units. I put 2 plus 3 years. Let's just say for this presentation, you are looking at a growth model of 25%. So that would put 2.5 to 3 vehicles on per year. So once you have this 2-year, let's say you're at the 2-year mark at 10 units, you really have 4 options to go in insurance. And your broker should be bringing each of these options to you. And I strongly recommend that if you have been with the same insurance company for more than 3 years, there's been so much disruption that your broker should be looking at new options and markets. So I would ask for a marketing summary. And what a marketing summary is just pretty much your broker saying, I've gone to market A, B, C, and D. Over the last 2 years, 70% of the insurance companies have pulled out, that wrote NEMT are out. So you can look at Hudson, Cardigan, you can look at National Interstate for under non-fleet under 10 units is out of the market. You can see that Progressive, although riding, is now not accepted by most ride brokers. They're Scottsdale, Nationwide are out. So I'm not scaring anybody, but those were artificially low rates. So now you need brokers that are more aggressively going after new markets or able to negotiate on your behalf and are aggressively getting that pricing back down and being more proactive in the operation about what you can do to mitigate or offset that increase in cost of insurance. All right, so on each of these models, I'm going to give you an example because it's easier for me to tell a story than go through what a composite pricing model is. So example of a composite pricing model would be that you're transporting ambulatory, non-ambulatory. You're doing for hire, which is NEMT. And let's say you're doing employee transport and you're doing some disposable med equipment delivery, and you have multiple different classifications inside your insurance policy. So for that for hire, which we consider to be the NEMT with this pre-scheduled trip, but you pay by a third party, that's going to give you one rate, let's say 8,000. And then if you're doing employee or paratransit, it'll be 6,000. And then if you're doing, disposable med equipment or lab samples, it can be 4,000. So composite pricing model, total cost of insurance, but everything is not lumped into passenger transport. It's a good option if you have a mixed fleet, if you are doing different activities outside of pure non-emergency medical transport, to look at a composite pricing model. It works well with operations that have multiple locations. And again, if you have a contracted paratransit route, which is outside of pure NEMT, then you can use this to reduce the cost of insurance. Second, a mileage model. This works great. This is really just a option to look at a per mile basis cost of insurance. So you drive 50,000 miles, you're at a rate of X cents per mile, and it's calculated over the term of the year. Good if you have a lot of wait time. If you have, let's say you're doing preset dialysis and you're sitting your vehicles, you're seasonal, so you have a peak during your summer months and you come down. It will only track the miles in which the driver is working. So this is working miles from when they clock in, enter the vehicle, let's say 8 a.m. in the morning to 5 p.m. So mileage model, the limitations, I have clients in this model. Normally it's a 50K starting premium. So it's not for everyone. It is for a fleet, but you can look at this. If you just feel that you have, let's say you have 20 vehicles and you've got 5 that are stretcher, and those stretchers, you're getting top tier dollar for those stretcher routes, but they sit a lot. Well, why pay the insurance for stretcher units that you're not using for ambulatory or non-ambulatory, or maybe limited wheelchair, but that you're paying for? So oftentimes this is going to be a better fit, again, if you have seasonal, if you have long wait times, or you have partial fleet that sit. Third, geographic modeling. Geographic modeling is pretty much just price per zip code. And this is a good option if you are in multiple locations, because the how pricing works for a geographic model is it's going to be zip code specific. So I see this in Florida with a lot of my clients. They'll have Miami-Dade, but then they'll also have operations in Orlando, and they'll split operations into several other counties. They'll be priced specifically on the garaging zip codes. So a Miami-Dade or Broward County rate is going to be twice the rate of an Orlando rate. So they are going to look at where they can place those vehicles. If there's an operating region, you can still work in the zip code in which, outside of where you're domiciled. But it is a way to look at a model that can offset the costs, a high fixed cost if you're in one metro area. And normally we can look at the highest pricing in a geo model is going to be your Chicago, your south side of Chicago, or your Miami's, your LA, your boroughs in the New York, your Detroit, Michigan, all these high metro classifications where you have a lot of claims, a lot of stop and go, and a lot of congestion. The InsurTech model, this is the fourth. This is what I believe our industry will move towards. And this is really just analytics. Right now, it's still the old school way of doing business, which means you go and you get an insurance policy, it's first dollar. They say it's $10,000 a vehicle. Good luck, go ahead. On an InsurTech model, they are looking at filing rates based on your behavior. Now, you're going to have to go to each division of insurance, each state, to get this completed. But the more data they have, the more that they can adjust the rates. So if you have good behavior, your driver behavior is good, they're pulling that vehicle information, that you stay within the speed limit, that you just have a good platform for your drivers. They control the exposure. You will be incentivized for this. This is something that I saw the filings go into the Division of Insurance in multiple states on the West Coast 3 years ago. They need about 3 years of data. Once they do this, they'll allow you to go in and say, we can get a rate that's half what the market rate is. So let's say we can go in and get a $5,000 rate that we're filed for, and then they can move that up and down. So again, it's getting a little bit complicated. I just want to put it out there that this InsurTech model, and again, InsurTech just stands for insurance and technology. It's a binding of insurance and technology with the end goal for the TP to pay less in insurance, and again, to control the behavior of the drivers, which is our goal, and at least build a culture of safety. Finally, and I'm not going to get into this today, I'm happy to talk one-on-one. You can reach out offline. There are the TNC models. TNC is a transportation network company, and everyone will think Uber and Lyft. It's more of a controlled TNC specifically for NEMT. So we do have a program for that. Again, these are really the 5 models that you're going to see when you're talking about fleet. And the depth that we'll go into on these depends about the size of the fleet and your growth objectives. If this is a single state, if this is a multi-state, single region, again, this is more for the fleet operators The non-fleet, again, I recommend going back and watching me and Nirab's video on, and just we can talk you, we talk you through I talk through the placement of non-fleet. Implementation of a fleet plan. I recommend having this conversation at the 3-year mark or 13-year mark, or today, if this is the first time you've seen it. What are you going to do over the next 2 years? And I don't spend a lot of time talking about what's going on with Doge and what's coming down the pipeline. Those are non-controllables. I don't see any impact. I'll give you my honest intake outside of this call. I do not feel it's going to impact our seniors. The inability to transport a senior to a required medical facility is unacceptable. So for the cuts to come across the board, I don't see that. I would say, if anything, the ride broker model is going to change. But for this, it's what's going to happen over the next 12 and 24 months. Every fleet client that I work with will have a growth plan and strategy for the next 2 years. And it comes down to, really the question is, how are you going to generate rides? And what is your model today? And what do you want your model to be? So this is beyond insurance. I'm sure Frank will talk about this, and you're going to hear this through TTA, Dan, as well. It's, am I getting contracts? Where am I getting contracts? MCO stands for Managed Care Organization. Am I going to work with hospitals? Am I going to work with, dialysis clinics? Am I going to work with memory care ops, assisted living, senior care? I mean, there's a myriad of options. But question, how do you get them? So an RFP, request for proposal. You'll get very familiar with these. If you haven't, I have some resources, some mentors that are great for this. Minimal cost to you to go through and really see how to present an RFP. From the insurance side, I have a client that is going after PACE. So PACE, it does work with contractors. They require a $5 million GL, a $5 million commercial auto, so general liability and auto liability. Average NEMT operator, it's probably on this call, has a $1 million policy and a $2 million. I advise that we have a conversation. I will get you an indicated pricing, and all that means is, what the contract limits are to get this. Do not buy the insurance. You're not buying the insurance with a hope and a prayer that you're going to get this contract. You need to embed that price, meaning you need to tell them what your pricing is, because you need to calculate that cost into the RFP. We will do the indicated pricing. We can put it on paper to show, okay, this is what we get. You take that RFP. If it makes sense financially for you, then we'll place that insurance over your primary, and it's called an excess placement. And we have a certain way that we do it, in which we write excess as of today when you bind the contract through the renewal, because excess follows a commercial auto, but it would be like if you had a month from now that you were renewing, we'd only write a 1 month excess policy. But again, first step is understanding requests for proposals, being able to put together a clean RFP, being able to focus on the financials to make sure it works for you, not buying any insurance until you're at a point in which you've got that contract. And again, the reason that you'll see a lot of, let's talk about large hospital group, have very high limits, is it controls or it's almost a buy-in. They want to make sure that you are vested, that you're going to take on those additional limits, because it is a high expense. But they only might take 2 or 3 RFPs. So this isn't, the ride broker model where everyone that has a vehicle is setting it in and saying, let's go to work. This is, okay, we've vetted these companies. These 2 or 3 are bidding. These are annualized or multi-year contracts. So this is guaranteed money. So this isn't ride broker reimbursement. This is a contract that you control for prolonged period of time. In this situation, it's a 3-year contract. So that is a fixed revenue source for the next 3 years. I talk a lot about gurney and stretcher. I'm careful on this one, just that you've got to check. This is state specific. For the purpose of this presentation, I talk from a macro level across all states. There are a lot of differences when it comes to um, gurney or stretcher specifically compliance, but look at expanded services. I would say I'm going to jump down to mentorship. Best way to do this is use TTA, use the resources. I do a mentor group once a month. If you are thinking about gurney work and stretcher work, talk to someone that's done it, that's doing it, that has a good awareness, that was able to get contracts, because it looks good on paper when you see the stretcher. When you see these contracts for stretcher, it's a little bit more challenging to get your guys trained and to be able to get vehicles that will fit that two-person job mentality. All right, want to jump into certificates. Again, this is pretty dry, so I'm going to keep it as simple as possible. This is an example of a Levy. This is a Florida contract. A Levy took the contract from Motive Care in Southern Florida. So a lot of you aren't going to have these 300, 600. Just to be aware, in Florida, it's different. It's by county. All counties are 300,000 requirement, except for Miami-Dade and Broward, which are 500. What I want you to see on this, auto liability has to be 289. So the days of 7, which are scheduled auto, are over. You'll see this a lot with the taxi operations that sat on 7, and I'm sure TTA members have seen this. Big shift. That's just, I have a vehicle, it's scheduled on my policy. If it's not on the list, it's not insured. 289 is hired and non-owned autos. The reason you need this is you have vehicles down in this business. You have a vehicle, transmission goes out, you pull it down. You have other backup vehicles that are scheduled. They need to be covered. You have leased vehicles, you have non-owned vehicles, you have contractors that are working. You need to have that coverage. So again, you're not going to see any ride broker that doesn't require 289. We go to the insured insurance company, and you can still negotiate if you're under Simple 7. If you have a contract, they'll normally offer 289. Again, the rates are not going to be as competitive because the exposure is different. As I said, Simple 7, no go. And again, this is an actual cert I reviewed for a client last week, and they were going through it, and they were, this is the first time they've seen an Levy cert requirement. So just, this is good to know. This is boilerplate, similar to Motive Care and MTM. Again, your SAM sublimit on this. The limits will be different. Again, this is Florida, so this is different than most states. But just consider the majority of states will be a $1 million commercial auto, a $1 million, $2 million general liability, and a $1 million SAM. SAM coverage again is sexual abuse and molestation. All ride brokers will require it. Some of your direct contracts will not. Anyone that works for the VA, they do not have a requirement for sexual abuse and molestation. Some of the network contracts will not either, but just when you're looking at your cert, just make sure you're 289. Again, a cert is just a summary. So I get asked a lot, hey, can you look at my cert? Do I have good insurance coverage? I have no idea. This is just a piece of paper that will get you a contract. I don't know if there's sublimits. I don't know if there's exclusions. I don't know if there's endorsements on the policy. So again, this is just a piece of paper that gets you the contract. This does not, and I repeat, this does not mean you have good insurance. I would need to look at that and read your policy to let you know if you have good insurance. But in this case, want to make sure that you understand what you're looking at on the cert now. These are scrubbed by AI. So if you don't have the verbiage 100% accurate, like in this case, you need to have Epic MD Technologies, DBA, Levy NEMT network. It has to say that exactly, or it'll kick it back out. So just be aware that a certificate is a certificate, summary of your insurance, but from a agreement or contract perspective, this is what you'll need. And finally, I just put, again, just as a reminder, the verbiage on these has to be 100% accurate. We check them. We're preferred vendor with Motive Care and MTM, so we know that pretty well. Something that you may not know if you work with MTM, they have to have an endorsement, which is a non-blanket, which has to be a non-blanket endorsement that says 30-day notice of cancellation to MTM or an NOC. A lot of people miss that. It has to be issued. Reason that I think Progressive is that they won't allow Progressive is because they've had issues with that. And again, I just want to let you know if you are with Progressive, your ability to get a contract for a ride broker is severely limited. So again, I can go into more detail. This is just a very, very broad overview of things that we see right now. All ride brokers will now require what's called a wet signature. And what that means on this certificate, I will have to actually print this out, physically print this out and sign it, and then scan it and send it back. Makes no sense to me, but they need to know that I am an authorized professional that will take on the liability of this. Have been a lot of claims that go upstream. Again, the TP gets sued, the ride broker gets sued. So in that situation, now it's gone full circle where they're compliance. So for those that remember the Logisticare days where we could pretty much get away with a certificate with, 4 box checked, and there was virtually or very little compliance. Now we've gone full spectrum where it's compliance. And they will pull your fleet, they will freeze your fleet if it's not 100% accurate and approved by the AI. On this is I always have a challenge with telematics because we look at it from an industry perspective is that everyone needs a camera in the unit to get the insurance. I would shift your view of this into the understanding that if you use cameras correctly, the data from the cameras and the behavior will improve your cost of insurance. And I project it to be 2026 when this will become, it's already mandatory with most carriers, but when we'll actually start using the driving behavior and analytics to reduce your cost of insurance, because there's not really any other way to go with insurance rates like they are now. The traditional model just doesn't work. And there's not a person on this call that's going to say, I'm happy with what I'm paying for insurance for my commercial auto. I don't hear it. It just doesn't happen. People are going, why? I'm best in class and it went up 12%. And I'm going, don't kill the messenger. I know I work for you, not the insurance carrier. So I make light of it, but this is for another conversation. We work with Lytx, Samsara, Motive. We have direct contacts with the demos for this. I recommend doing a partial fleet test. Test the technology. They'll normally give you 30 days to test the technology at no cost. See if you like it. See what their dashboard looks like. If you don't like it, go back and try someone else. I'm not going to advise you. I'm not compensated in any way whatsoever. I will just give you honest viewpoint from my fleet operators, and I'll put you in touch with them who are using it and like Lytx and those that like Samsara or those like Motive or Motor Technologies. So very important to start if you have not already used a camera system. And this is an embedded camera system. This is not the old plug-in I bought on Amazon and I'm going to put the chip in and pull it out. Putting the data to the sky, having your ops manager, having your dispatcher actually log in, see what the behavior is of your drivers, do an audit. Just pull. All I do is I say once a week, watch a driver for 5 minutes, see their behavior. It's all it is, 5 minutes. Block it in on Friday, pull it from the week. You can go back and look at the data. It's a great way to do that. So again, I think that we're going to see a shift. Insurance lags behind all other industries when it comes to tech. So we're still probably 5 to 10 years behind other industries. But now with the speed of information and the ability to maintain large data, video data, we are going to see more and more of this data driving, knock on wood, the reduction in premium for operators that are best in class. So again, finally, I think that we don't talk enough about claims. On the right-hand side, here's what we use. I'm big on reporting as it occurs, because our memories, you asked me what I did yesterday, and I could probably tell you 5 things I did and 10 things I didn't. Report the claim in real time. Here's what we use. Whatever source you're using, this is the information that the driver's inputting into the from the accident site. So we have everything right there. This may change. He's not going to have the policy number. He may not have the police report at that time, but he's going to be able to input this information on his phone and upload 6 pictures. And we do a basic accident incident report, make sure he's out of traffic highway, out of danger first, and then take the 6 pictures, front, corner, side, back corner, back corner, side, front corner. So again, this is just a simple explanation or a simple app that we use. There's a lot of operators, tech companies that will provide this same service. It's easy, it's effective. Have your claims filed, even if you're not at fault. This is a question I get all the time for fleets. If you don't report it, if it's a not at fault and it's non-reported and they come back and subrogate, meaning the driver's with Geico hits your car, it's 100% his fault. You don't report that claim, they come back and they subrogate against you because he had $30,000 policy and you have a $70,000 vehicle and they can't pay it and your uninsured motorist has to pay. That's a claim on you that you haven't filed a claim in a timely manner. File every claim. Again, we have a claims manager in-house. All they do is work as your manager on every claim. So when that report comes in, it goes right to my claims management desk. He works with the adjuster. The average adjuster for commercial auto has 132 cases on their desk. That you're not that important to them. And I'm surprised that people still get frustrated. TPs still get frustrated. Hey, I haven't heard anything on this claim, because they'll get to the claim when they get to the claim. They'll pay to go away. You know, the insurance company it's a unilateral contract, so they can control how they want to pay that claim, if they want to pay that claim, and how timely they want to pay that claim. We have Raphael in our office, who's a pit bull, who's going to push them for responsiveness, follow up, follow through, documentation, and with the end goal of getting this claim closed. You know, we want a timeline. We want to know when it was inspected. We want to know when the recovery was, when the adjuster went out, did the spot check on the vehicle, when the check's being issued for the vehicle if it's a total loss. So again, your expectation is on your risk management should be your partner, and whoever that may be, should be that they work and handle your claims. I do not feel that that anyone that gives you an 800 number to call your insurance company is doing their job for you. If our job is to be your risk management advisor and partner, we should be doing that. Claims is a huge piece of the insurance equation. So again, I do get passionate about this just because I see in any given month maybe 100 claims. So I see what works, I see what doesn't work. And again, working directly with your insurance company that not often uses a TPA, which is a third-party administrator, to handle that claim, it's diluting it. So you want someone that's working on your behalf, aggressively pushing the insurance company to pay, to settle, to close. Going the wrong way, let me. So I'm going to leave it at that. That puts us right at 40 minutes. Again, I put my information down. Strongly recommend, if you are interested in learning more about NEMT fleet growth, EMS, and emergency services when it comes to transportation, follow me on LinkedIn. We post educational content every Thursday. Again, non-sales driven, more education about the industry, what's going on, compliance, systems, policies, and procedures, fraud, and waste. I also have my email. You can give me a call. I do recommend if you want to block out some time to do an analysis or review of your fleet operations, or if you want to look at a growth timeline, you can get on my calendar. I normally block out 30-minute sessions. And then I did put the QR code at the bottom for anyone that is just looking at their current NEMT fleet insurance and wants to look at our program. Whoa, how did that picture get in there? So, well, now the cat's out the bag. That is my daughter, 6-month-old Kennedy. This was her first tea party. I was not invited, but I did do the transportation. So I transported her from her nursery to the living room and back. So that's my transportation piece. I'll leave it at that. I'm going to pass it back to Nirav to do the Q&A.
Well, Mark, that's a mic drop right there at the end.
You like that? Got to keep it gets dry. So I like to make sure that, we keep a smile on people's faces because again, that there are a lot of positives coming down the pipeline. So
a lot of gems of wisdom, and you saved the candy for the end.
Exactly.
All right, Q&A time. We've got our first question from the one and only Howard Berkowitz. What are your thoughts about captives in the NEMT business? And Mark, I think maybe you can explain what captives are to the audience.
Howard, good question as always. So a captive is a financial placement. It is a owner-controlled insurance placement that's financial in nature. Just think of it as you have 10 operators that come together and they pretty much own their own insurance program. It has a fronting paper, so it's compliant for issuance for contracts. And then you have reinsurance that covers you against exposure. Advantage of a captive is that there are dividends paid. Normally it's best in class, so the owners will get money back. So I think the better I perform and the group performs, the more money potentially I can get back on a dividend each year. So you're paying in with the idea that we perform and we're safe and we get money back. We're also protected from cat loss because again, the reinsurance will cover that. They're domiciled normally outside of the US. You do a captive meeting. Our captives are in the Grand Cayman. So we go down to the Cayman where you meet similar operators. Best in class, good option. It's, I think you need to understand on captives that you do a lot of deep dive into financials. It's a personal guarantee and it's a buy into a captive. So expect it to take 6 months. Captives are an excellent placement. If you do not plan to sell in the next 3 to 5 years, you're not looking at getting acquired, you are not diversifying in the business, you can grow in a captive. It is going to be the most competitive option you have as you grow the fleet, because traditional pricing models in insurance become so out of line when you get into, let's say, the 100-unit fleet, that a captive is going to be strategically the best move for you. So happy to talk about captives. We also do a two-year play, a lot like the fleet business growth plan, on how to obtain or how to enter a captive. And if you're in it for the long haul, I couldn't put a bigger bow on a captive, because again, you literally will save hundreds of thousands, if not millions of dollars.
All right, interesting. Mark, it appears that your presentation was so comprehensive that the rest of the audience is left speechless without question. Everyone, if you want to put your question, oh, here we've got another one. Okay. Question. Does Swan Insurance cover workers' compensation?
Good question.
Apparently
Yes, we do.
Not working on the site is what this questioner is saying.
What was the second part of the question?
Oh, this questioner is saying, hey, the link is not working on the website. So he's asking, does Swan Insurance cover workers' compensation?
Oh, okay. Yes. To answer your question, yes. Happy to do that.
Okay. Simple, quick one.
Yep.
Again, everyone, if you want to ask questions, just hit that Q&A box at the bottom, type them in. I'll shoot them over to Mark. Okay, a question from Shalonda. Actually, not a question. Shalonda is saying, very comprehensive, still processing.
I speak very quickly and I put a lot of content out there. So again, I understand there's, for the first time, it can be a dump of insurance information. So again, I have no problem once you digest. to reach out to me because, again, we're covering a lot of topics. We're covering topics that would probably take 2 days in a seminar to cover in 45 minutes. So I want to put it out there. Just to understand what's going on in the market. I don't think we talk enough about where insurance is going and what you can do now to position yourself for growth and profitable growth. I mean, our profit margins are tight, so insurance is a high fixed expense, and we need to do everything in our power to reduce that. So that's where we're forward thinking in the idea that what are we going to do to reduce, let's say, reduce 10 to 15% your rate next year and the following year, instead of this idea that I do everything right and then my insurance broker comes in 5 days before renewal and sends me this quote and it's 10% more. Like, what can I do? And I understand the frustration because I see it, I hear it, and it doesn't pencil out to me. It's like we're doing everything right, yet we're still taking this rate. So that's where we get creative and we'll negotiate on your behalf. It's our job as field underwriters, meaning we understand your risk better than the insurance carrier does. Let us paint it in the most favorable light and show them that you're going to do and you've done everything correctly to become a best-in-class operator.
All right,
So,
Mark, looks like the audience has processed and we've got a couple of questions. So,
okay.
question, we currently have Samsara. Is there anything we can do now to begin reducing rates or begin getting our data to be used for InsurTech?
Okay, great question on that. Samsara can be linked by API with two InsurTech markets. So what they're going to do is normally when they onboard with the InsurTech partner, they're going to do the API. They're going to start sharing that data. Then you'll have a risk analytics score. So once you start sharing that data, let's say you have good data, then they score that from a 0 to 100. So the higher you get on that analytics score, the lower your rate will be within 25%. So it can bring down your fixed cost of insurance by 25% if you're perfect. But let's be realistic. Let's say it brings it down 15%. Well, that means for the next 12 months, you can expect, if you have a high performance score, to have a renewal that's going to be 15% less instead of the traditional model, which across the board, I would say everyone's taking about 10%. So you're really getting a 25% reduction because you're not taking 10, you're saving 15. So we can talk offline about that. But yes, to answer your question, Samsara will share, they have the API connected. So they're using your behavior, the analytic data to score your operation for the commercial auto. Again, this is just a commercial auto.
All right. Question from Igor. Mark, can you speak of GL policies and when coverages happen, such as loading and unloading coverage?
Great question, Igor. I appreciate that. One of my clients as well. So on GL, let's take a step back. In commercial auto, your loading, unloading, your uninsured, underinsured motorist, and your injury to passenger in transit are the three claims, 1, 2, and 3. Loading, unloading will either fall on your commercial auto or your general liability, professional liability. If you have two separate policies, you need to make sure that it is covered on one. And normally it will be a sublimit. So on a commercial auto, if it's a standalone, they'll give you $1 million of auto liability with $100,000 loading, unloading. But you need to check with your broker and read and say, okay, is it covered in the commercial auto? If it is not, it will fall under the general liability. And normally they don't sublimit that, it's the full limit. So if you have a combination, a health services policy, this means it's placed one carrier has all lines, then it will fall most likely. It'll either fall on the commercial auto if they feel it was warranted on that, or the general liability, but it's covered. If you have two separate policies, you need to check both to make sure that it's either covered on the commercial auto or if it's on the general liability. If it's on the general liability, you get full limits. So it's good on the GL, but a lot of GLs will exclude it, and a lot of commercial auto policies, specifically commercial auto policies that aren't written for NEMT. So a traditional commercial auto policy is they want nothing to do with loading unloading. If you have an ambulatory person, someone that can get in and out of the vehicle, they're not going to cover loading unloading. They don't really understand the exposure when it comes to wheelchair. So to answer your question in a long response, check both policies, find out if you have a sublimit on the commercial auto, and then look at if it's not on your commercial auto, it's on your GL. But if it's not on your commercial auto, then your GL, you need to go through with a fine tooth comb.
Okay. 4 more questions. I think we can knock some of these out pretty quickly.
Okay.
If I just renewed, would I be able to switch or make changes?
25% earned premium. All that means is that if you just renewed, the insurance company requires 90 days, well, 25% of the total premium. So you could move the policy, but I recommend waiting that 90 days so you're not double paying for your insurance. So you've got 3 months, earned premium. After that point, you can move your policy at any time if you feel there's a better option.
All righty. Question from Laronia. What's your feedback on National Interstate?
Oh, that's a loaded question. Anyone from National Interstate on this call? National Interstate is got out of the market for non-fleet. So they have pulled out of all markets in the United States for non-fleet business. They have taken some rate. They are very, very strong on loss control. They have some sophisticated fleets. They have good claims servicing. They'll do a 2-hour loss control meeting with you each year. They are focused on controlling exposure. They have good coverage on limits. They are I have not seen them as competitively as they once were. It may have been because of the exposure they had with the non-fleet business that's drived up their expense ratio. And they may be having to take some rate because of that. So that's my politician response.
All right. Well, we'll leave it at the politician response. Okay. 2 questions from Dwight, which actually I can answer. So number
Good,
1,
thank you.
will you be sending out an audio file or PDF of this presentation? Yes. TTA will be emailing a recording of this presentation. And on Wednesday of next week, this will also be released, this whole presentation, on the NEMT Experts podcast on Bambi's YouTube channel. And Dwight's second question, what do you consider fleet and non-fleet in regards to the number of vehicles? I believe that is 10 vehicles, right, Mark?
That is correct. 10 vehicles, 2+ years of operation. Again, you're going to get fleet pricing normally with a 10-unit fleet. Non-fleet, you are limited. It's normally standard markets. So non-fleet, you are paying a single price per unit, not a composite. So all that means is, let's say I have one vehicle, it's 10,000 a year. I add another vehicle, it's 20,000. Another vehicle is 30,000. So it's a fixed model pricing. Once you get to 10 units, there's more flexibility because you're in a fleet program on price per unit.
Okay. Next question. So are those insurtech markets the ones providing the insurance or the ones adjusting it with our actual insurance? I'm a bit confused on the part on how the insurance is adjusted by the data for when the actual premium is billed for.
Good question. So this is a insurance-backed product. So the insurance carriers here, they have the technology company that's working with the insurance partner to provide that information. Now they're still they're compiling that data. So they need your data to be able to price that on the analytics model to reduce your cost. So that's why I'm very bullish on the telematics systems and test the waters and find a good system. The cost of that will be minimal. If you let's say you spend $10,000 a year on that, it can save you $50,000, $80,000 on the average fleet per year on insurance. So again, they're using your data to give you a score, and their system is working with your telematics, your camera system, and they are bringing that in to price up or to price down your insurance. So there is a carrier, there is an insurance, a traditional insurance carrier on that, but that insurance carrier has allowed a technology company to come into control and pull that data and review that data and give an analytics score, which reduces that cost. And there's two in the market right now, and I think we'll see more that come down the pipeline. But again, it's still a traditional insurance company that's insuring you. It's just a technology company that's using the data to get you to provide that information. They're processing that, and they're telling the insurance company, this operator is performing very well. We want to keep this operator, reduce this cost of insurance. So it works well if you're a good operator, you have good systems, and that you're tracking your driver behavior, and you're using dash cams and telematics. There's no reason you shouldn't look at InsurTech for a placement, because again, as I said, that 15% reduction is really a 25% reduction, because in the standard market, you're expecting a 10% rate increase.
Okay, last question.
Yep.
What are the names of the InsurTech partners in Samsara at the moment?
I'm happy to talk about that. Reach out to me. My contact information is on the slide, and we can talk in more detail about that.
Speaking of which, that'll wrap up the Q&A. This episode will be sent out by the TTA, the recording, and it'll also be released this coming Wednesday again on the NEMT Experts podcast on Bambi's YouTube channel. I will be putting the contact information of Marc and Swan Insurance in the description of this video on YouTube. And thank you so much to the TTA for putting this on, and to my dapper man, Marc Crawford.
Thank you, Nirav. As always, it's a pleasure spending time with you. And I want to thank everyone for spending an hour with us. Reach out again. I can't say enough about the TTA as well. I look forward to seeing you all this year in Las Vegas. So be well. Have a great day. Thanks again.